Hi everyone, welcome to episode number 94 of Ask a Property Manager. Today is October 27th, 2021, and I'm coming to you from Studio 2.0 here at Own Buffalo. I'm Andrew Schultz, principal broker of Own Buffalo Inc., and on today's show, we're going to be talking about a surge in single-family home rents, why foreclosures are starting to come back to market very, very slowly. We'll take a look at some questions from housing providers around the country and so much more. But before we jump into that, we are going to go ahead and plug our social media. New episodes of Ask a Property Manager drop every Wednesday at 10 a.m. Eastern. You can also catch the replays on our YouTube page that same day. The live episodes go up on Facebook, obviously. Don't forget about our Instagram. We post content there that doesn't make it to the other two platforms. Last but not least, don't forget about the Rent Prep for Landlords podcast. The current episode of the podcast talks about what to do when a tenant won't comply with Section 8 repairs, screening and renting to international applicants, and the critical importance of screening your tenants properly. Don't miss out on that. New episodes of the Rent Prep for Landlords podcast drop every other Thursday, anywhere podcasts are heard or over at rentprep.com/podcast. We're going to jump into our news of the day here, starting with this article from CNBC. Foreclosures are surging now that COVID mortgage bailouts are ending, but they're still at low levels. Foreclosures are starting to surge as government and private sector programs designed to help homeowners deal with the economic fallout of the COVID-19 pandemic have begun to expire. Mortgage lenders began the foreclosure process on 25,209 properties in the third quarter, a 32% increase from the second quarter. On a year-over-year basis, it's a 67% increase from the third quarter of 2020, according to Adam, a mortgage data firm. Keep in mind there really wasn't much in the way of foreclosures happening last year in 2020 due to all of these pandemic protections. While the increase in foreclosures are dramatic, they're coming off extreme lows that were created by the forbearance programs. New foreclosures, also known as starts, usually number around 40,000 per month. They fell to as low as 3,000 to 4,000 in the first year of the pandemic when forbearance programs were in full force. Government and private sector relief programs allowed borrowers with financial difficulties to delay their monthly payments for up to 18 months. The missed payments could then be tacked on to the end of the loan period or repaid when the home is sold or the mortgage refinanced. States with the largest number of new foreclosures were California, Texas, Florida, New York, and Illinois. Despite the increased level of foreclosure activity in September, we're still far below historically normal numbers, said Rick Sharga, Executive Vice President at Realty Trek and Adam Company. September foreclosure actions were almost 70% lower than they were pre-pandemic. Total foreclosure activity is also still 60% lower than it was a year ago. Whether the increase is a prelude to a more serious problem or just a return to normal levels of foreclosure is one of the bigger debates going on inside the industry right now, said Chagra. Large numbers of borrowers are now exiting forbearance programs. The biggest weekly decline so far came last week. The number of borrowers in bailout programs dropped 11% week over week, according to Black Knight, a mortgage data and analytics firm. The number of active forbearance plans fell by 177,000, led by an 84,000 plan drop among the FHA and VA loans. As of October 5th, nearly 1.4 million borrowers remained in pandemic-related forbearance plans, representing 2.6% of all active mortgages. The majority of those coming out of the plans, once again, are current on their payments. Some of those who aren't current on their payments are working with lenders on loan modifications. Those who do not contact their lenders or who still cannot afford any payments are either selling their homes or going into foreclosure. The foreclosure numbers should stay relatively low because of aggressive modifications by lenders and also because of high levels of home equity due to the recent housing boom and consequently high home prices. Prices were up over 18% year over year in August, according to CoreLogic. We're going back to that point in a couple minutes. I think the forbearance cliff will be minimal, said David Stevens, former CEO of the Mortgage Bankers Association and former FHA commissioner in the Obama administration. Unlike the Great Recession, where home prices dropped approximately 20% from peak to trough, this recession saw home values rise by roughly the same amount. So while we should see some foreclosures, the likelihood is that there will be far fewer from a percentage basis due to the ability to sell a home versus default or stay in the home due to far better workout options and higher re-employment. Foreclosure numbers will likely continue to rise through the end of this year and return to normal levels by the middle of next year, according to Sharga, I think it's pronounced. They may tick up a little higher than usual, but still plateau far below the kind of tsunami we saw during the Great Recession by the end of the year, he added. So the one point I wanted to come back to on this article was this one right here. Should stay relatively low because of aggressive modifications by lenders and also because of the higher home equity. This is actually going to be a very, very good thing for the overall market, because if we didn't have this surge in home pricing and all of these foreclosures hit the market, it would decimate the existing market because foreclosures generally drag the market down. I can remember back in the early days of the recovery, let's say 09, 10, when Orlando's MLS was literally over 50% foreclosures. If you were looking at single family property in the Orlando MLS, it was over 50% foreclosed properties. And when you have, 3 foreclosed properties on your block and you're the only home that's not a foreclosure, trying to justify a higher price, it sometimes becomes a bit difficult. So it's not a good situation to have a ton of foreclosures out there in the market. It really does drag everyone else down. So hopefully this is accurate, and that these higher home prices give people the option of making a sale rather than going through a foreclosure. I know that was the case in the Colorado market. They saw a large drop in the number of foreclosures in the Colorado market because the price of properties went up so drastically. When you started to see that exodus of people from other states into Colorado, their prices went up on their properties, which saved a lot of people from going into foreclosure. I know an agent that used to actually do a lot of foreclosure business out there, and they had to completely retool their business simply because there just wasn't enough foreclosure business out there to support what they were doing. So, interesting article on foreclosure surging. The article does mention that we still have a long time before this is going to be a thing. Here in New York State, obviously there will be some of the previous foreclosures from pre-pandemic that will be kind of filtered out and pushed through to the market. I do expect that there's going to be at least a little bit of a lull after that. And then probably 24 months down the road, when we start seeing the bigger amount of foreclosures hit the market, that's when things will really start to get interesting. We're going to take a look at another article from CNBC, this one on single-family rents. Single-family rents are surging and investors are flooding the market. Demand for single-family rental homes is showing no sign of easing up, and that is pushing rents through the roof, especially for the highest-priced properties. As a result, investors are now flooding into the market again after falling back a bit during the first year of the COVID pandemic. Nationally, rents rose 9.3% in August, year over year, up from 2.2% year over year in August of 2020, according to CoreLogic. For the first time since the pandemic hit, all major metro housing markets covered by CoreLogic showed positive rent growth. Miami led the way with a 21% gain, followed by Phoenix at 19% and Vegas at 15%. Converging economic trends are driving a surge in single-family rent prices, and consumer confidence has driven an uptick in demand for both renters and buyers, Molly Bozel, economist at CoreLogic, said in a release. The ongoing preference towards more living space and slim for-sale inventory is forcing would-be buyers back into renting, putting significant strain on single-family rental market. And I would say that that's probably accurate. I think a lot of the, especially the first-time home buyers who have been out there trying to find something, I think a lot of them have soured on the market, maybe cooled down on the market a little bit. They're not in quite as big of a rush as what they used to be. And it is pushing them back into a rental situation in a lot of instances. The gains have investors rushing to buy and build more rental property. In the past year, there were roughly 43 announcements totaling more than $30 billion in capital targeting U.S. rental housing, according to tracking by John Burns Real Estate Consulting. Since some of this is only the equity investment and excludes the debt, we know of far more than this that is not public info. The real number is much higher, wrote Danielle Wynn, Senior Manager Research at JBREC, in a release. Wynn cites several reasons for the investor demand. Worldwide bond yields are at historic lows and investors need yield. That makes sense. Inflation is on the rise, and most investors view rental homes as an inflation hedge. Record high rent growth is supported by high occupancy rates. Renters have demonstrated that they are willing to pay a premium to rent in a new home neighborhood managed by a professional landlord. The last point is supported by rent growth according to price tier. Lower priced rentals, 75% or less than the regional median, rose 7.1% in August year over year, up from 2.4% in August 2020. Higher priced rentals, 125% or more than the regional median, climbed 10.5%, up from 2.3% in August 2020. Even as overall home sales fell back slightly in August, investors made up a larger share of sales than August 2020, according to the National Association of Realtors. Meanwhile, first-time home buyers, who historically make up 40% of sales, were at just 29%, the lowest level in more than a decade. Home prices continue to rise sharply, weakening affordability but bolstering demand for rentals. So this right here kind of highlights the point that I had just made, that there are a lot of first-time home buyers that have either soured or slowed on the market and are going back to a rental for at least a little bit here. I can say that we are kind of seeing that in the Western New York market. I can tell you that we are no longer seeing, in a lot of instances, the mad rush with 20 or 30 offers. It's down to a more reasonable, 2, 3, 4 offers in a lot of instances. It's not nearly as crazy as what it used to be. I'm not going to say that that's a sign that the market is slowing down, but I will say that I don't think it's quite as red hot as what it was just a couple months ago. Let's take a look at some humorous things I found on the internet. This thing makes me laugh every time I see it. I don't know if I've shown this one on this show or not, but at least here in Western New York, I don't know if it's like this in other areas. Spirit Halloweens pop up everywhere. Between Spirit Halloweens and chocolate shops, we have so many like 1 and 2 month type stores like that in our region. It's kind of funny. And then if you hired an electrician and they did this, you probably need a new electrician. That's really the sole point to that one. I just saw that and thought, ooh, that's pretty rough. All right, let's get to our questions from housing providers around the country. We're going to start with this one on accepting cash payments. On yesterday, I closed on a 7-unit apartment building. Shortly after closing, I learned that some tenants pay rent in cash to a convenience store clerk using a coupon from the previous landlord. Does anyone have a strategy for contact-free rent collection from unbanked tenants who prefer to pay rent in cash? So the service that they're referring to there is actually a service called Pay Near Me. You can find it online at paynearme.com. It's actually super useful. This is not sponsored, but we do use their service. It's pretty much available in every Walmart, CVS, and 7-Eleven location. Essentially how it works is you give the tenant a coupon, or you can send it to them on their cell phone. You can send them an email or whatever with a PDF file, and they can scan the barcode when they go to the store. And essentially what happens is they display that to the clerk. The clerk scans it. The tenant will pay their rent to the clerk. You get an instant notification in your email that the tenant has made their rent payment. The tenant gets a receipt right there from the clerk showing the time and date that they made their rent payment, and then the money hits your bank account in a couple of days. It's a really, really nice setup. It's pretty streamlined. We never had any issues with it, and we use it all the time. The tenant does pay, I think, a $4 fee or something like that when they make their rent payment, but the option of the biggest alternative would be buy a money order, buy an envelope, buy a stamp, and mail it. And by the time you buy the money order, buy the envelope, buy the stamp, and then mail it, you're spending $4 on that. So this is a little bit better solution for a lot of tenants because it means, number one, no lost rent payments. Number two, they can prove that they made their rent payment. Number three, you know when your rent payment is on the way. There's never a question of, oh, the check is in the mail or whatever the case may be. So if it's an option for you to use that Pay Near Me service, that would actually be one of those things that I would strongly recommend. You see if there were any other points I wanted to touch on that. There are some other options out there for contactless rent payments. Obviously, if you're not going to use a service like Pay Near Me, the most obvious solution would be what I had just discussed. Get a money order and mail it. There's going to be a charge to get the money order, and it's one of those things that you have to kind of hope that the tenant actually mailed it. The nice thing about money orders is every money order that I've come across has a number on the back of it where you can actually call to track that money order and see if it's actually in existence, if it's been cashed, what the status of the money order is. I know the Western Union ones have it. I know the MoneyGram ones have it. And that's kind of convenient because at least that way the tenant can send you a picture of the receipt or the money order, and you can verify that the money order hasn't been cashed, or if it's, at least that way, if it hasn't been cashed, you can almost assume that it's in the mail, maybe. So other options would be open a deposit-only bank account and provide the tenant with deposit slips. Not every bank will do that, so that's something that you would have to talk to your bank about and see if that would be an option for you. Really, the preference here would be to get the tenant into some kind of a bank account so that they can make online rent payments with a routing and account number or a debit card or an online bill payment or, whatever the case may be. Even something like Venmo, Cash App, PayPal, you have to have a bank account for all three of those. I don't recommend those for rent payments, by the way. That's a totally different topic. The main reason being that the payments can be reversed on those platforms, Venmo, Cash App, and PayPal. So I don't recommend those for rent payments. Realistically speaking, at the absolute last resort, I would just accept cash. We do tell tenants we don't accept cash in the field. If they want to make a cash payment, they do have to come to the office to make that payment. But realistically speaking, we don't want cash. We want tenants to convert the cash to a money order because it's way safer for everyone involved to not be walking around with a giant pile of cash. On to our next question on flood damage. Who's responsible? Tenant A's child left water running overnight and flooded the unit and the unit next door. There's no major damage. Tenant B had a tablet lying on the floor and is now requesting the landlord to replace it. Tenants are required to have renter's insurance to cover personal property, etc. Should landlord be responsible for replacing, or should they take it up with tenant A or request the tenant to take it up with their insurance? So I assume that the landlord here is going to be opening a claim with regards to the damage caused to the units if the tenant does have renter's insurance. And let's hope that the tenant does, because even though you say there's no major damage, you're going to have to do a dry out. You're going to have to run fans and dehumidifiers. If you have carpets, you may need to pull them to dry the pad and the flooring underneath. It might look like not so much damage, but until you get into it a little bit further, you might not realize just how much damage there is. So you're going to have your own claim to tend to, essentially, is what I'm saying here. If you haven't started that claim already, you need to get in contact with the insurance provider. You can either contact your insurance provider or tenant A's provider, whichever, and start the claim that way. If you start the claim through your insurance, they're going to attempt to subjugate it back to the tenant's insurance. So that's generally how those processes would work. So with regards to tenant B's tablet, there's nothing that you have any responsibility for here as a landlord, at least to the best of my knowledge. I should probably have prefaced this whole thing by saying I'm not an attorney and you might want to speak to one on this. But as near as I can tell, tenant B's personal property was laying on the floor of their apartment and was subsequently damaged. Their personal property is not the landlord's responsibility. The fact that tenant A caused a flood, which caused damage to tenant B's property, might mean that tenant A is responsible, but that's probably something that the insurance companies are going to argue out. My recommendation would be have tenant B talk to tenant A, try to set up a claim that way. If tenant B is not getting anywhere, then I would tell them talk to their own renter's insurance policy, their own renter's insurance company, and try to get their renter's insurance to go back after tenant A's renter's insurance. Either way, I don't think that the second tenant has any claim against the landlord in this instance. Again, I'm not an attorney. You probably would want to talk to one just to see if you do have anything here. But from where I'm sitting, I think that this would be something that would be covered under the tenant's renter's insurance. Our third and final question, running credit and background checks. Hello, I'm in Massachusetts reviewing 3 applicants for an apartment. My question is, if I run background checks as part of my screening process, but I see that one applicant already has a super low credit score, which would cause them to get denied, do I have to move forward with performing the background check anyway, just to say that I screened everyone the same way? I make the applicants pay the fee, and I feel bad having them waste their money, but I also want to cover on my end. The safest play here is to treat every application exactly the same, so there's no question as to how applicants were treated when you screen them. It's very straightforward. If you handle everything the same way every time, you really don't have anything to worry about. Build a complete file on your applicant, including any documentation that you require in terms of proof of income or proof of residency. Run your credit check, run your background check, do them both on every application, and then weigh that application against your written criteria. When you treat every application the same, you're really doing 2 things. You're minimizing your risk and you're maximizing your chance of selecting a good tenant. And at the end of the day, I think that we can all agree that those are both positive things. Those are both the types of things that you're trying to do. So when you treat every application the same and you use a set of criteria, a written set of criteria that is fair housing compliant, it really helps to de-risk a lot of the tenant screening process. That would be my recommendation. Treat every application the same, get your criteria squared away so that you know how you're screening, and then base every application off of that criteria so that you know that you're following the same process every time. That pretty much wraps things up for this week's episode of Ask a Property Manager. Thank you all so much for watching, and you can always help us improve by doing us a favor and dropping a question below in the comments, either on Facebook or on YouTube. Your question may be picked up and answered in an upcoming episode. If you enjoyed this content, or if we brought some value to your day, do us a favor and hit that thumbs up button. YouTube and Facebook both push videos based on community feedback, so every like, comment, subscribe, and share helps us to grow and reach more people. We'll be back next week on Wednesday, November 3rd, 10 a.m. Eastern with another show you won't want to miss. Thank you all so much for watching, and we'll see you next week.